2024, central banks probably fended off recession by injecting liquidity into the markets. And so the big question for 2025 is that likely to happen again? What are the indicators showing, potential indicators of where we might be heading for in 2025 in terms of recession probability? So just going to take a look at some of these main indicators that usually look at for trying to figure out where we might be heading. So the S&P 500, just on a seasonal basis, obviously in November and December, is usually strong. We'll probably see that again. So, I mean, it's gone up recently after the Trump victory, probably come down a bit and then go up into the end of the year. That's what most analysts and big banks are predicting. 2025, however, I think could be quite either anemic or we will see the recession. So let's take a look at some of these indicators then. So my go-to chart is the Chicago Fed's National Financial Conditions Index. So that's a comprehensive weekly update on the financial conditions in money markets, debt, equity markets, and the traditional shadow banking systems, or traditional and shadow banking systems. So it's all of the kind of main components of the financial markets really. There's also an adjusted NFCI, which is focused more on just the financial conditions and is less correlated with the economic conditions. So just take a quick look at this. So what's showing here is the various components here in different color codes. And as we can see, for 2008, the Great Financial Crisis, we see a big spike up here. So above the zero line is bad, below the zero line is good. And if I just pull this to the right, we should see that there is currently no signs of any of these kind of problems in financial markets. The adjusted national financial conditions here as well, they did start to show some signs of weakness here in 2022, but that seems to have recovered as well. And so this is showing currently, I mean, it can change quickly, as you can see here, but currently no signs of distress in the financial markets, according to the Chicago Fed. Manufacturing PMI, which for the US, we do focus quite a lot on the US market because the majority of global index funds are in US stock, 75%. So, US markets are where most of our money will be invested if you're in global index funds. And the manufacturing PMI, bit of a mixed picture. So it's been below 50 for a little while now. It was below, so 2024 has been a fairly good year for stock markets. Just come down on manufacturing PMI, which is potentially leading indicator. It's been below 50 now for a while. Sometimes there's a lag between going below 50 and maybe some bad things happening in the financial markets. But it's been below 50 for, going back before 2024 as well. And 2023 was a good year. So it's a sort of mixed indicator, but as you can see, 2022, it came right down and with financial markets. So I guess we just see if the length of time below 50 is probably what we're, concerned with here. If it stays below 50, doesn't go back up, then the US manufacturing sector will be going into some sort of decline. So keep your eye on that one, but that's not bearish, not bullish really. The conference board, which a lot of people go to for leading indicators. So the leading economic indicators for the US declined by 0.5% in December, following a 0.3% decline in August. Over the 6-month period between March and September 2024, the LEI fell 2.6%, more than the 2.2% decline over the previous 6-month period. So we've got a weakness in factory new orders, continue to be a major drag on the LEI in September as global manufacturing slump persists. So overall picture, according to the conference board, is that we still have this global slowdown. Additionally, you've got a yield curve remained inverted. Building permits declined. Consumer outlook for future business conditions was tepid. So overall, the LEI continue to signal uncertainty for economic activity ahead and is consistent with the conference board expectation for moderate growth at the close of 2024 and early 2025. So they're still saying moderate growth, despite the downturn in their leading economic index. So again, not necessarily not bullish, but not necessarily overly bearish. According to their, so there's 2 recession and growth trackers that they publish, and so the coincident economic indicator signifies the state of the current economic conditions, and the leading economic index provides an indication of where the economy is heading is in the near term. So the coincident economic indicator is in the slowdown quadrant. So it's 4 quadrants: recovery, expansion, slowdown, recession. And so currently in slowdown, and then the leading indicator where we might be heading to, they are judging that in the contraction. So contraction quadrant, so signaling possible recession within 12 months. So they're saying it's kind of okay for now. Looks okay in terms of having some moderate growth, but the risk, they are saying, is to the downside over the next 12 months, with a possible risk of recession in 2025. Isabel Net, a couple of recession indicators here. So market implied probability of recession starting within 1 year. Let's take a look at this. So this one is from Goldman Sachs, and hopefully that's going to display here. There we go. So still pretty high. It's going back to 1950. So they're saying the current market implied probability US recession occurring within the next 12 months stands at 29%, which is significantly higher than the long-term average. And as we'll see, some of these other probabilities here are also sort of pretty high, really. So again, the overriding evaluation here from these other indicators as well is going to be that there is still a significant chance of recession. We didn't get it in 2024. Central banks injected liquidity and probably fended it off. But the probabilities are still showing up on these various sources, various indicators, to show that there is still a decent chance that we will see it in 2025. So remains to be seen. We have to wait and see. Another one here is from the Federal Reserve Bank of Cleveland. So again, I'll just show this one here on the index page here. So probability of US recession calculated from the yield curve. in the next 12 months is 43.2%. So it's November the 5th. So it's still well above 2008, for example, well above 2020, and well above the dot-com crash in 2000. So pretty high. US heavy truck sales, which sounds like a bit of a strange one, is actually quite an accurate indication of a peak in heavy truck sales occurring before recession. As you can see, we have had a very high peak here. This is going back to the 70s, two in the 70s, two in the 80s. This one before, I think that's .com, or Great Financial Crisis 2008. You'll see we've pretty much reached those peaks recently as well. So again, another indicator showing potential chance of recession. We have got the often quoted real-time SARM recession indicator, which triggered recently. This is before, this is going back to the 1960s, has triggered every time before a recession, going back to the 60s, and has just triggered recently. Then reports of Claudia Sarm saying that it's different this time. Seems like she might have been pressured into saying that, I don't know. But going back to the 60s, this has worked or triggered every time before a recession. And it's just triggered. So if we continue to see this spike up here, then again, this is looking like we could see this recession in 2025. There again, it could go down. So we just have to keep our eye on it and see what happens. Moving over here to micro. So they have quite a lot of information that you can take a look at. Some's free, some's paid. So their global recession probability, similar to before, is about 45%. So it's still pretty high. Unemployment then, it's probably one of the main, well, it is one of the main factors. It's probably the main factor in, determining if we're going to see this recession or not. Again, this graph long term, going back to the 1950s here, you see it spiking up when the grey bars are recession, spikes up for recession every time, basically. So it's before 2000, starts to spike up. 2008, Great Financial Crisis, starts to spike up. That's COVID, so you can pretty much ignore that. And once again, we're seeing, it's hard to see here, but you're seeing this spike up here. That depends if we start to see this kind of trajectory, which would be, the continued rise of unemployment leading to probable recession. When you get to these kind of levels here, you can see it's pretty high on a historical basis. So we are not far away. And it continues depends if we see this sort of rate of acceleration here, but yeah, we're not there yet. So, but the direction is pointing towards that towards that end. FactSet, who report on earnings, the S&P 500. So we have the highest 12-month P ratio for the S&P 500 in more than 3 years. So there's no doubt that this market is November 11th, pretty recent. So this market is extremely highly valued. For 12-month P ratio for the S&P 500 was 22.2, which marked the second straight day the P ratio for the index was above 22. So the forward 12-month P ratio was above the 5 most recent historical averages. So it's high. It's priced very highly. As you can see here, this chart going back to 1999 for the dot-com crash, and that was at the COVID high there, and we've reached that COVID high in the price to earnings valuation. So the risk is at these high values, number one, you don't see big gains going forward, and the chances are there's more of a probability that you see declines going forward. So that's the risk. Maybe we go up a bit more and we get a blow off top and then we come down. So finally, global liquidity. I just found this chart on TradingView, but macro micro actually showed a kind of different measure of liquidity, which showed it going up, but that was with just the four main central banks. So there's Federal Reserve, Bank of England, Bank of Japan, People's Bank of China. Whereas this measure here I found on TradingView is someone who's put together this global liquidity index, which shows those banks and a whole bunch of other central banks as well. So on a global basis, and probably the reason for this global slowdown is that liquidity is being drawn out of the markets by the central banks overall. So come down in 2022, kind of flat since then. So that's a decline in 2022. And then flat to sort of going down on the lower band here. So maybe this is support and we see it go back up here. But as far as our global funds are concerned, if we see this continue down, trend down, that means liquidity on a global basis with all of these central banks is declining, and potentially we could see stock market declines if that global liquidity continues down. So that's the picture. So overall, there does seem to be still this spectre of recession hanging over the US market. If that plays out, the only thing that would save a decline in the US market and therefore our global index funds would be liquidity being injected once again by the central banks. The question would then be, would that be enough? So 2025, I think, is going to be a pretty interesting year. I think there'll be these opposing forces. I get the impression we actually might see this recession. It's been coming for quite a while. So I think 2025 could well be the year that we see it. And so therefore, I think there could be volatility in global index funds. So that's what we'll be tracking. That's what I'll be tracking on boombustinvest.com. And like and subscribe, help the channel out, guys, if you like this video. And as I say, I'll be tracking this all throughout 2025. So come back for these reports if you like, and comment and let me know what you think. Okay, cheers, thanks, see you in the next video.